Transfer of tax losses between resident taxable persons. The rules regarding the transfer of tax losses between taxable persons are a key component in ensuring that tax losses are utilized in a fair and efficient manner, particularly within corporate groups. These rules allow for the transfer of tax losses between resident juridical persons, subject to specific conditions, to optimize the tax positions of the entities involved. The purpose of these rules is to enable businesses within a group to offset tax losses against the taxable income of other group members, provided that the transfer of tax losses aligns with certain requirements that ensure fairness and prevent tax avoidance. Key conditions for transfer of tax losses. To facilitate the transfer of tax losses, the following conditions must be met. 1. Ownership requirements. One entity must have a direct or indirect ownership interest of at least 75% in the other entity, or there must be a third entity that owns at least 75% of the shares in both entities. This ensures that there is significant control and influence between the entities involved in the transfer, and helps to ensure that the tax loss benefits are transferred within the same corporate group or structure. 2. Shared financial year. Both entities must have the same financial year. This condition ensures that the transfer of tax losses occurs within the same accounting period, allowing for a clear and accurate offset of tax liabilities and preventing mismatched timing that could complicate tax reporting and compliance. 3. Uniform accounting standards. Both entities must prepare their financial statements using the same accounting standards. This ensures consistency in how the entities recognize income and expenses, which is crucial for accurately determining their respective tax positions and ensuring that the tax loss transfer is valid and fair. 4. Exemption and free zone exclusion. Neither of the entities involved in the transfer can be an exempt person or a qualifying free zone person. Exempt persons are typically those that are not subject to corporate tax, and qualifying free zone persons may benefit from certain tax incentives that exclude them from regular tax obligations. The exclusion of these types of entities ensures that only taxable entities benefit from the tax loss transfer rules. Timing and conditions for transfer. To ensure that tax losses are transferred fairly, the qualifying common ownership conditions must be met from the start of the tax period in which the tax loss is incurred to the end of the period in which the transferred tax loss is used. This ensures that the ownership structure remains consistent throughout the process and prevents entities from manipulating the rules by altering ownership after the loss is incurred. The transfer of tax losses reduces the amount of tax losses available to the transferring entity, which means that the entity transferring the loss will have its available losses reduced by the amount transferred. This reduction helps to prevent double benefit claims and ensures that the tax losses are utilized only once. Maximum offset of taxable income. The recipient of the tax loss transfer may use the transferred tax losses to offset their taxable income, but this offset is limited to a maximum of 75% of the recipient's taxable income for the relevant tax period. This ensures that the recipient entity still faces a minimum level of taxation, which prevents the complete elimination of tax liabilities through the transfer of tax losses. There is no minimum amount that must be transferred, meaning that the transferring entity has flexibility in how much of its losses it chooses to transfer to the recipient. However, the amount transferred cannot exceed 75% of the recipient's taxable income for the period. This ensures that tax losses are distributed in a way that reflects the taxable income of both the transferring and receiving entities. Multiple transfers and recipients. A single taxable person may transfer its tax losses to multiple taxable persons, provided that the ownership and operational conditions are met for each recipient entity. Similarly, a recipient entity can claim tax losses from more than one transferring entity, as long as the total amount of the tax losses transferred does not exceed 75% of the recipient's taxable income for the period. This flexibility allows for a more efficient use of tax losses within corporate groups, ensuring that the tax relief is spread across the entities that need it the most. Example of transfer of tax losses. To illustrate how the transfer of tax losses works in practice, consider the following example. Example 23, Transfer of tax losses between C LLC and F LLC. C LLC owns 75% of the shares in F LLC. Both companies are resident juridical persons and meet all the necessary conditions to qualify for the transfer of tax losses. In the tax period ending 31st December 2026, C LLC incurs a tax loss of AED 2 million, while F LLC makes a profit of AED 2 million in the same period. C LLC decides to transfer AED 1,500,000 of its tax loss to F LLC, which is the maximum amount that F LLC can offset against its taxable income in this period. After the transfer, F LLC will reduce its taxable income by AED 1,500,000, leaving it with a final taxable income of AED 500,000, AED 2 million, AED 1,500,000. C LLC will carry forward the remaining AED 500,000 of tax losses to the next tax period for potential use against future taxable income. This example demonstrates how the transfer of tax losses between related entities works, with the transfer helping to reduce the tax liability of F LLC, while C LLC retains the remainder of its tax losses for future use.